welcome Sankalp, and and I'm sure a lot of you are familiar with us and me. So welcome to PMS AIF World's latest edition of Invest Sense webinar series. Today we have a very special guest and a very special fund management house with us to represent their views. So before we get to that, let me just thank you all for your support for our mid-year confluence of fund managers. We have had more than 2,000 participants. Thanks to all of you for attending the webinar. If you've missed, you can view all the videos on our YouTube channel, PMS AIF World. And while you're there, you can also book a call with us if you want to know more. So with that context, let me welcome you. We have Mr. Anil today from Right Horizons. Right Horizons is one of the most efficient end-to-end wealth management solution provider. They have been around for almost close to a couple of decades. They're 18-year-olds now, 18-year young now, and I'm sure they've had their fair share of learnings, and they provide a lot of unique services to their clients. A little bit about Mr. Anil before we move on to the topics of discussion today, and it's going to be a little bit more interactive today. So please keep sending us your questions. We'll try to take most of them. So Mr. Anil Rego is the Managing Director and CIO at Right Horizons. He manages around 4 funds at Right Horizons. The more popular ones are FlexiCap and Super Value Fund, which have done exceedingly well over the last few years. He is an MBA and a CFA charter holder. He prefers the contrarian style of investing, and he is one of the most seasoned investors around with a couple of decades of experience. He regularly features on business television channels and print and online media articles, and also teaches at a lot of leading management institutes. The interesting thing about him is that he's also authored a book which has a very interesting title called "Honey, I Lost All Our Money." So that's indeed really interesting, and we'll start with that. Anil, I hope I have done justice to your work of 20 years. So we'll begin with this point. Why did you write a book called "Honey, I Lost All Our Money," and what led you to write this book? Over to you.
Yeah, thank you, Sankalp, and thanks for having me on the platform. It's my privilege to be part of this PMS AIF World. Actually, the book is about my experiences as an investor, right? And also, as a wealth manager, advisor, fund manager. So I try to bring together, all my experiences and in story form. The trigger point actually was, when one of my client who was, above 50 years, and he was the CEO of a company. He ended up subsequently selling the company and stuff. But he was like on a lot of committees, managing his own company, finances, and all of that. And sort of after he ended up moving on, he started, investing in markets. And with one of the, broking entities, he ended up putting money in the F&O side. He was doing very well. In fact, we used to meet often, and when I used to share the portfolio, and he'd say, "Yeah, at times maybe your portfolio is slightly conservative." So, but my whole view was, you need to manage risk well. And what actually happened was he came to me one day and told me I need, an X amount, about 1 crore from the portfolio. And it sounded very desperate. That was in early 2008, and then of course he sounded very tense. So I didn't feel like asking. I told him, yeah, luckily we had book profits on your portfolios. We are sitting in cash, and we are ready to sort of we were planning to reinvest if on the fall, and you have missed this out. And he said, no, I really need it, and I need a little more than what is there in liquid. So I told him that we need to exit, at losses for certain, positions. So that was a point when, later on when I asked him, he said, I actually lost all of it on the F&O side. He lost, initially he made a lot of money, He put a lot more and more and more, and he missed the turning point of the 2008 market fall, and that was really costly for him, and he lost 3 crore beyond all the capital that he had put in on a cumulative basis. So my thought was, how do I educate investors, and how do we ensure that such things do not repeat? And I said, okay, it's time that sometime I should write a book and bring in all these learnings so that other people don't make the same mistake.
Thoughtful, and I think the story almost resonates with a lot of investors, and I hope we don't get to hear such stories, but that's how markets are. Markets humble us more often than we think. So good. So with that introduction, now we will get to business and what we are actually here for. So Anil, would you take some time to introduce the Right Horizon brand? Okay, the name sounds very enticing and probably a little bit philosophical too. So tell us about the nomenclature, about the brand, what you do, and a little bit about your heritage in terms of what have you learned managing money for clients over the last 18 years.
Yeah, so we started Right Horizons in 2003, and it was basically there's a story to that as well. Okay, I wanted to retire from corporate life and start on my own, and I set it myself a target of at 35. I wanted to set out on my own, and I said I don't want to impact my family, so I said I'll build a certain capital as a backup capital, and once I have that capital is when I will set out on my own. And for me, right from early days, again, I started investing in markets from my second PUC days. Okay, and the good part was, I didn't lose too much of it. In fact, in early days, I even took a loan against securities, reinvested that, and did some of those crazy things. Okay, subsequently, of course, I must tell you that I've not done any leverage trades. Okay, but the good part was, when interest rates were going up, I exited, always looking at the contrarian style. And so when I was, observing people come to me and ask for suggestions of, how to manage their money, I felt that, that is something that maybe will be useful. The second part of it was also about, the planning side. I was in the business planning and mergers and acquisitions of Wipro, and we used to do a lot of planning for companies. That in 2003 there was not much of financial planning existent at that point of time. So I felt this is something which is critical, and just like I achieved my goal, okay, I want to help others achieve their goals, and that's how the name also Right Horizon resonates with that. Okay, so that's the thing. I mean, our lot of learnings over these years. Okay, and I think we'll spend this whole session if I go through that. So let me, focus a little bit on, what is it that we stand for, and stuff like that, and what has been the learnings that we have. So let me first actually go back to my overall learnings over the years, and I think so. If you go back and see, right, my book itself tries to capture many of the learnings on personal finance, but coming to markets, right. It's all about markets tempting you to do the opposite of what you should be doing, right? You actually feel like investing, when markets are at a peak. And because of the way our minds are and the way we are constructed to look at past data, right? When I see the best past data, it's probably the worst time for me in markets, and vice versa, right? And that is something which, again and again, over periods of time, and myself being a bit of a contrarian investor, I thought, I always used markets as a, when everybody looking the other side, I would, look to invest in the, in areas which are sort of beaten down. At the same time, it's not just doing exactly the opposite. It's about studying, underlying. This is a second learning of mine. Okay, is about looking at data, right, and making those informed decisions. Okay, and while you're contrarian itself, you have to look at, for example, today I will look at, global markets, inflows, outflows, currencies. I track gold. I would, look at commodities, and wholesome, then you get to learn a little bit of the market cycle. Okay, And let me give you an example also, of gold itself, right? And not too many equity investors talk about gold, right? So, I've successfully used gold again and again because gold is a fantastic asset along with equity because it actually reduces your risk. And at times when equity is really battered, gold really runs up fast because you even if you have a debt equity asset allocation, the issue with debt is it doesn't run fast. Okay, when markets are falling, markets fall 60%, my debt at best would go up some 8%, right? So I would still see a whole lot of losses. So gold sort of does that. And when, even in the recent times when gold hit $1,200 per ounce, we went and bought. Even I gave a recommendation to investors saying that, this is, you're giving a buy call on gold. Not too many people actually invested in it. Okay, because I mean, they were almost 4, 5 years, 6 years of pathetic returns. Okay, and they were really frustrated with it. And that's also a time when, we like to see it. Okay, the third aspect to, or the learning is about, about managing risk. And that's, again and again, I think markets repeat. And you will always see that the falls are much larger. Okay, and which is why it's very important. Let's say let's take the last large rally, which ended in say 2008, right? It went all the way, I think, from almost like 3,000 of the Sensex to 20,000, right? 20,000, 21,000 odd. But when the fall happened, okay, and that would have taken maybe a very long period of time, right? Multiple years. But when the fall happened in 2008, it fell, from 21,000 odd to right to 7,900 or 8,000 levels, and all of that in just 10 months. Okay, so that's the point. And a fall from a high is really crazy, right? So if for example my portfolio has gone up 100%, so 100 rupees become 200 rupees. If a fall of 25% also on 200 rupees means I've lost 50 rupees, right? So that's the thing there. So managing risk is important. My other learning is, of course, part of that also is from my experiences in Wipro and other companies is about process. And when I studied other fund management entities on the mutual fund side and the PMS side, I think the ones which managed a good process actually, delivered consistent returns. So that's my sort of other learnings. And I think the last one I will say is try to learn from your mistakes. Okay, there are lots of them that I myself would have made. Okay, and the point is, try to see what is it that you can do, and to learn from your mistakes and not repeat the same mistake at least. Okay, so that is some bit of learning, and possibly I would add one more, which is about can you look for continuous learning? Okay, there's everything is evolving, and if we just markets humble you if you think you know all, right? It'll come back and then you'll not know what happened when your portfolios do badly, etc., and you miss the turn. So that's I think the other extension that I would sort of like to take about right horizons. Over the years, we built it step by step. From 2003, we managed in excess of 1,500 crores of assets overall in our group, as well as on the PMS platform, we manage about 450 crores of assets. Okay, and within the PMS side, I just took over the reins of the fund management from early 2019, and earlier we had professional managers. For me, stocks were always my passion. So when I go back to my early days, I used to invest in stocks, and I always said that once my last place where I retire is in the fund management side and stocks. So I think now that things have evolved to a reasonable level, and there was a change that came in, on a fund management side, I said, okay, let me actually take it up. And there also, that's been a very good learning. And the volatility that we saw in recent times, was suitable, for my understanding of cycles. So that helped us also do well. I think that's a broad and introduction about Right Horizons.
Right. I picked up a lot of things from your learnings, okay, and I therefore ran a poll. And I asked investors on this call today that I am bullish on the market, bearish on the market, or neutral. So around 75% said that they're bullish on the market.
Okay.
So that kind of brings me to the question that I'm going to ask you. Okay, so you've had these learnings, and let me just forewarn all investors that anything that we speak is more educational than advisory. So with that disclaimer in mind, okay, so just take us through your processes at Right Horizon. Okay, we've noted that Right Horizon PMS has been one of the top performers in the last financial year, and kind of continued over the last couple of months as well. So what has been your process, or what is your process of stock picking at Right Horizon, and how did it complement these times, okay, where we are, as much as we want to deny, we might be in a more structural bull run. How did you stand true to your process and maintain that, and ultimately as a function of that kind of have the performance that you delivered? So what do you?
Yeah, so Sankalpo, if you can bring on the presentation, I
Sure.
thought the process is best done on structured way.
Sure, just a second, I'm just bringing up the presentation.
We need to go to slide 10.
Yeah, just 1 second. There is. So while we
Yeah, so maybe let me start off. Okay.
Yeah, so the presentation is also up. So you tell me which slide to go to.
Yeah, I'll maybe 10. Yeah, further.
This.
No, further. You can. Okay, maybe we'll come here. Okay, sorry. And yeah, so basically we have a four-stage process. In fact, my thought here was to have it, each stage of the investing process, is captured here, and we run it in a very structured way. The first is, the screener. Then we call it the RHS. Then we have the pendulum. We have the scorecard. The pendulum is trying to, time the market buys and sells, etc. The scorecard and the risk radar. I will capture each of these, in detail. Okay. Yeah. So the screener basically, my thought is to give a little more detail than just the surface. Okay, so I think as investors, also if you are investing in stocks, if you have something to learn, that's great. Okay, and we believe that knowledge is key, and starting off with the RH screener, basically we first look at the overall universe, and then we apply certain criteria to it. Okay, the criteria could include the growth in sales, the ROS, ROC. We also look at certain criteria which exclude. Okay, the exclusion criteria as well, and these may come back, in terms of market cap. It may be, certain pledging and debt equity ratios, etc. We could also have, a few metrics which are exclusion metrics, and then we also look at other potential for disruptions. Okay, ideas for turnaround triggers. So we look at those from at the next level of screening some of these before we come to a final shortlist. And that final shortlist, we capture a set of stocks, and we also look at them versus their respective benchmark. Okay, so that whether it's a large cap, a mid cap, etc., we would sort of funnel it, and this RH screener sort of becomes the first part of our overall process there, which is basically screening and coming to companies. And what is the objective of this? The objective of the screener is to ensure that we look at companies which are consistent. And if you see, a lot of these measures are looking at a 3-year growth rate, a 3-year ROCE, etc. Okay, and that is something which is sort of important to us, because we're not necessarily like looking to get stars in the short term and see volatility, because it's also not part of our overall philosophy. Okay, the second one is actually getting into the next level of detailing, right from building financial models, looking at P&L parameters, valuation metrics. Okay, and so we look at a lot of those factors as in terms of a financial modeling. We also would look at the balance sheet as part of that. Debt to equity ratios, the interest coverage, and various other balance sheet measures which we look at it. Then we start looking at efficiency measures like the ROE, ROC, asset turnover, because in some form that gives us an idea, because I think what I believe is numbers don't lie beyond a point if you look at it for extended periods of time, right? And where you are able to look at that deep dive, you know how efficiently a company A is managed versus a company B. So that is something which helps us to look at it in terms of a scorecard. We have, again, like I said, some bit of on the risk side and quality side, where we look at aspects like promoter pledging, etc., as part of our forensics checks. Okay, we will also look at what is the level of institutional holding, the credit rating. We also do certain checks on the managements beyond just what is captured here. And the last is a bit of a qualitative filters. Okay, because I think what is important also is to be able to look at companies beyond numbers into the future, right? As to which are these companies which are sort of well positioned to become upcoming leaders, which are the companies which have growth triggers in, have tailwinds, which can sort of take them forward, and if they are able to create a disruption, that is something which sort of helps. While we do it also, I think we try to look at ones which sort of are just coming to the next level, because where we see transitions like that happen, it actually makes a good sense to invest in them for the quickest return. The risk framework is another one which is very, very important for our overall framework that we have. And so looking at, and this is something that we also do not only at the start but on a continuing basis, and that's why we captured it separately as well, right? So every quarter, every month, there are certain parameters that we continue to keep checking, because say you may have invested into a company, but then after that you don't want to miss out on certain aspects that come in later. So that is something that is sort of very, very important to do. We also, as part of the risk side, look at various risk measures on the stocks, the beta, and aspects like that. We also look at, as part of the risk framework, the sectoral caps, stock level caps, okay, and also look at the business mode, in terms of how they can manage for the future. And the last is, in terms of looking at the RH pendulum. The RH pendulum basically looks at trigger levels. Now, it's also important, in our view, to manage the timing as much as one can. And we found that many times we've looked at companies that valuations are very steep and we're uncomfortable with, and we pull them out of the portfolio, and either they stay stagnant for a long period of time, or they end up even correcting sharply. So that is something which is what we also do, and we do it on various parameters, right, from technicals to fundamental P ratios, etc. And also we look at market cycles, because at times you need to superimpose that. At times you can take a higher risk, at times you cannot take a higher level of risk. So that is something which we also sort of look at. So I think to bring it to life, maybe to give an example, and when I'm talking about stocks, I must say that this is more for illustrative purposes and for learning. and this is not a we are not going to give any buy or sell recommendations on any particular stock. Okay, so that is something that we sort of keep in mind. And so this is a company which is Dixon Technologies, which is an outsourced manufacturing. It really benefits from this whole environment right now, China plus one, and we saw that early, and it's been a early pick for us, much earlier, and it's done very well for us in our portfolios. So, like I said, I'm not commenting on whether we will continue or not, okay, on the particular stock, but just to give you a flavor of how we go about it. So that is the whole, competitive thing beyond some of the processes that we spoke of, right? So it's important to see what are the changes and transitions that may be happening in the environment, which sort of provide tailwinds for the company. And at that time when we started, there was some bit of tensions between China and the US, trade tensions, and then that was an opportunity where we said, let us go back and look at this particular stock. If you looked at the stock, the customers that it had, phenomenal set of customers. They are basically, for those who don't know Dixon, it outsources electronics manufacturing, and so Dixon is a bit of a leader in that space, and they have some of the most marquee global MNC companies, looking to outsource manufacturing, from Dixon. So that is something which, all on the qualitative side, and on the financial side anyway, we have done a lot of the detailed number crunching, etc. But difficult to, show all of that here. So we just capture, for example, from the parameters that we spoke of, like net sales growth, okay, versus 8%, which was our threshold. The company, delivered 21.44% 3-year growth. The ROC, our benchmark was 12%, and it delivered 31.74%. Okay, debt equity also was like 0.16, almost no promoter pledging. So sort of a company like this, both from the strategic qualitative side, where we're looking at an emerging leader, made sense, as well as from the financial side.
So should I stop the presentation for a while now?
Yeah, you can do that, please.
So that was very interesting, very insightful, and I think screeners work best. However, just for trivial, I just ran a poll on how many people on this call actually use screeners to either select stocks or funds. Close to 45% said no or sometimes, which means that the process is somewhat unique, and screeners involve also a lot of personal, how you look at these parameters, like you said for Dixon, how you look at a particular screener. There could be cases where you might be okay with some checkboxes not meeting, or in certain cases you would be absolutely rigid about checkboxes meeting. Okay, so how did this entire process of investment that you explained in detail work for Right Horizon during the crash of 2020, the COVID crash, and ultimately also in the revival and in the rally, the returns that you made over the last 1 year or in this calendar year? How did these two gel together to get the returns?
Yeah, so actually we got good coverage as well from media, for our performance in 2020, and like I said, it was interesting that it was a conscious call that we took. So October to December of 2019, okay, we were uncomfortable with valuations. Okay, so we ended up cutting down on various parameters. For example, we increased cash on the portfolio. We had financial stuff, in line with the index, and reasonable percentage, which we again sort of reduced significantly. We sort of invested into pharma. Okay, at that time pharma was beaten down and not actually something that people wanted to look at, because again pharma had a very, very long period of down. Okay, but we felt it was a good defensive, and we also looked at cutting down on even on the financials, like we let go of the tier two and the smaller names, etc. Focused on the core ones, and that sort of paid off very well. And so when COVID hit, we were very, very well placed, and we took various measures. Interestingly, we sort of deployed back and we increased the risk as markets were falling. Okay, so that is something which so FY20, for example, the flexi cap fell 21.2% versus the Nifty 500 versus the benchmark index of the fund fell 27.6%. So almost like 6 odd percent, we did better sort of than we fell lesser than the index. And must keep in mind that at that point of time, most other managers ended up actually falling worse than the index. Okay, because they were all, I think, running for growth and stuff like that, both on the mutual fund side and the PMS. We found, I think, many managers actually underperforming and actually falling more than the index. Okay, now coming back to the good part is because we invested and increased our risk when markets fell in COVID. Again, it was a period where we also went back to clients and said, come and add money. Okay, and some of them listened to us, some of them very nervous, saying that we've not seen something like this before. But that's something that the discipline that we took, saying that when markets have fallen, it's safer for us. And again, coming back to my understanding of cycles and an overall organization, where we see fear on markets, we believe the turning point is near. Okay, so that is what we saw in markets, and we were reasonably confident, and we did that. And the good thing is in FY21, so because of various other investment decisions and measures that we took, right, we ended up growing 79.9% in FY21 versus a Nifty of 76. Okay, so we got an alpha of another 3% in that point. And the good part is, we crossed the highs earlier than the index, much before the index, because of this particular approach. So our whole portfolio and philosophy is about not necessarily only looking at risk and saying, okay, let's look at low returns because risk is because this is meant to be a more evolved product, and it's meant for investors to be able to take advantage of opportunities as well. So we look to take when the time is right and take advantage of opportunities, but we're not necessarily trying to be the best performer, when markets are high, because like I mentioned, based on experience, the falls, whenever it comes, we've not seen one, okay, can be steep, right?
And to tell you about this, Anil, this is something that we also subscribe to. When you look at equity, what do you think about? You think about risk or return? It's very important to understand that equity is to create wealth, disproportionate wealth. Risks are a part of that process, but you would rather you would be a happier person focusing on where you can get your return from. So that's a very interesting take. So we'll come to the question about cycles in a while, because you have seen a lot of them in the last 20 years or so. But the question that I want to ask you next is a follow-up on the process question. So do you attribute performance, or do you attribute top quartile, top decile performance only to processes, or would you say that there is something else to the process, that is beyond the process, that also helps gain that edge in performance and also maintain that performance after over longer periods of time?
Yeah, so I think there are two things that apart from process, which are important things to look at. One is, like I said, the ability to be able to look at a crystal ball gaze, right? So to be able to look at the future and say, okay, what is it that can or that is likely to do well in the future? Okay, so there's a lot of the qualitative strategic side and study of it. The second part of it is, I think, about cycles. Okay, because process in itself is one, but so what we look at, for example, is we may change the mix. I may still look at the stock, right? But I may say go for larger cap and use the same process, right? So I may change a little bit of the mix a little bit, based on the overall view of cycles, and that is something which I think together, helps. One is you get consistency through process, and better quality also falls lesser. But secondly, if like you are able to be out of the market and also manage it, see, you will not be able to get the whole exact timing, right? So you need to leave out some bit of the timing there. So even during COVID time, in the portfolio at least we had deployed a little earlier, and when at the last we came back to clients and said, there's opportunity further, why don't you invest? So that is, I think, a combination of these two which sort of make and it sort of becomes important. And let me give you an example. Maybe when I'm saying cycles, I'm saying looking at the future and stuff like that, and going a little beyond just the company itself. So specialty chemicals was one segment that we liked, and the trigger point for us when we saw data that Chinese manufacturing was actually going down and going down reasonably well. And it was that the trend was sort of visible for a period of time, thanks to pollution measures and other things and restrictions that the Chinese government had brought in there. And the other corollary was where will some of this move? And I thought India was going to actually benefit from it. And the specialty side, then when we dug deep a little further, right, which evolved over a period of time, it was a slightly specialized area. So the team also reached out to other people from industry, people from the IT network, etc. And we were able to actually understand that yes, some of the companies are very well placed. So which is where we sort of went ahead and sort of added some of it, and a few companies. In fact, we added across portfolios companies in specialty chemicals, and they all did phenomenally well. So that is something which is an example of how going beyond just the process side, and in terms of analyzing what we think will do well for the future. Sorry, I lost you. I can't hear you.
Yeah, sorry, I was on mute. So it's a very interesting answer. To put, to continue your answer there, cyclicity or cycles, business cycles, market cycles. So I think we are in a transitioning cycle. Okay, so steel, the real economy stocks or old economy stocks, as a lot of other people would call them, have seen good rally, fantastic rally, stock prices doubling, profits doubling. A lot of them announcing capex. Okay, so across these cycles in the markets, cycles keep happening. So, you could call it the mid cap cycle, the small cap cycle, the quality cycle, the growth cycle, whatever you may call it. So what is your learning of these cycles? And like you said, it's important to get the cycle right. Okay, so what is your take on cycles, and what do you we'll just make it a little bit interesting, and what do you see as the next cycle to be, or if we are in the midst of a cycle, according to you, what is this cycle going to be like?
Yeah, so I think there are various cycles that are, and you're right, we believe there's a lot of transition that is sort of happening. And this, I think, started a little earlier as well. And some of that, for example, the move from large cap to mid caps. In fact, into 2017, for example, we sort of moved out of mid caps into large caps, and mid caps did see a steep fall when we did early 17. So similarly, about almost like a year back, we went back and started adding mid caps and increasing exposure. And what is the reason for it? The reason for it was looking at data. We just tracked relative strength of large cap to mid cap index, and what were those inflection points, and we felt that we were at a point which was closer to inflection. So even actually before the mid cap things started moving, we started slowly adding mid caps both in our portfolios. In fact, on the wealth side also, it was easier to do through systematic investments, etc. But that is something that we sort of have kept adding, and continue to look for companies that have grown. So similarly, if I look at we have strong views on maybe even the global side. Maybe the US has done very well. And we are reasonably negative about the US, because our view is the leader of the previous decade sort of is a laggard for maybe even up to 2 decades, not just one. So that is something which sort of is the other one. Within, I believe like manufacturing, etc., coming back strongly vis-a-vis some of the other industries which did well in the past. Okay, I think consumer will probably take a little bit of a slowdown in relative sense to some of the others. So I think there are a whole lot of, and I think also value. I think value will also sort of come back a little bit. So while we are doing our various processes, we also tightened certain parameters on the valuation side. So those are small changes we may make in our process itself, to take advantage of certain market conditions. So I think going forward, if I also give my outlook, so I would believe that we will end up seeing continued positive movement. Okay, however, we are going to see some bit of volatility as well. We saw one round, in 2020, and I believe that markets also need those intermediate corrections. So I think if it was not for COVID, it would have been for something else. Okay, market just sometimes needs a reason to do what it has to do, and we would, I believe, find the reason later, and so which is why I believe that looking at risk-adjusted return is very, very critical for an investor at this point of time, and I think it's not an option anymore, because valuations, as you can see, are sort of going up. And my warning also to investors is better times and huge performance times are ones which you need to be cautious about. Okay, even though you may really feel like investing. Okay, so when all of the IPOs thing and various momentum comes in, I'm sure maybe some the Zomato, etc., were early ones. Maybe it will do okay. Okay, and it may not do badly. It may do reasonably well. But I think over a period of time, you go and catch the next one on the basis of Zomato. You probably and after one or two more, you will find that you are catching the ones which are likely to fall. So I think it's about, and if I stick my neck out while I said about the US, I think and believe that India would be the star of this decade. Okay, because and many people, and one has been saying this a little bit earlier as well, even through COVID times, because again looking at cycles, and we had a very bad decade ending 2020. Okay, so if you go back and look at debt returns were better than equity returns of the Sensex and Nifty. So from that standpoint, also from a turning cycle, as well as a lot of the initiatives and a lot of the measures that have been taken, I think will start evolving, and you'll probably see things moving in this decade, even for people who are little negative, saying that okay, can we see third wave, etc. Yes, so there could be volatility, but be careful. But I think and manage risk, and I'm sure you will do well and grow your wealth. You're on mute.
I think this is "you're on mute" is the word of the year or something like that. So we have a lot of interesting questions, but before that, one question that I would like to ask you: you've got a lot of not lot, but quite few strategies under the Right Horizon umbrella. Can you just give us a brief onto what strategy is for what kind of investors, or what kind of investors should look at what strategy, and then we will take Q&A from the audience, which are few of the questions are very interesting. So
yeah. So, Sankalp, while I talk, if you can bring out the presentation, there's one slide. Also the risk and return, okay, where we captured, for a few of our strategies. See, I believed in, providing the whole range to clients, and while we manage risk, this one. So while we manage risk, okay, my view is that we also need to, see how do we take advantage of opportunities and stuff. So we also de-risk from ourselves. So the thought is, we have two other fund managers apart from myself, and they run things pretty independently, so that we're able to take advantage and have different ways of working. And so if the range is right from the lower risk side. I have a balanced fund which has three risk levels: conservative, moderate, and aggressive. Okay, and then we go off into the large cap, which is where we have India business leaders. We also have another AI based portfolio which we sort of are seeding, and that's called Alpha Bots. And we have flexi cap, which is in the flexi cap side. It's really different from multi cap because it has a lot more flexibility, thanks to flexibility that we have as PMS versus, say, the mutual fund side. And I also have, let's say, gold as part of it. We don't take large exposure in gold because it's meant to be a return portfolio. But in the last move that happened, we actually made 50% plus returns on gold, right, on the portfolio there. And that the good thing is that there was a period when other things did not move. Right? So then we have super value, which is a portfolio on the mid and small cap side, which is also done well. We have underserved and undervalued, so there are other strategies there. And we have a fund of funds which we introduced on, which is a bit of an actively managed fund of funds, which is called All Seasons Mutual Fund of Funds. Okay, and that's called All Seasons, and so that also could have debt on the portfolio, but we benchmark it against the Nifty. Okay, interestingly, so whatever returns you are seeing here, right, is despite having debt on the portfolio. Okay, and so that is sort of brings down the risk for us substantially. And I like to look at both risk as well as return measures. Okay, and if you see on many of the risk measures, we also do very well, sort of in comparison with the index, as well as if you look at average monthly returns, which is sort of telling you on the consistency of performance. Right, so that's the the whole picture about the funds that we have at Right Horizons.
Right, very interesting. So Anil, can we take a few questions from the audience now? And there have been quite a few.
Yeah, please.
So the most interesting question that came today on the chat today is from Mr. Madhusudan, and I'm asking you this because you've also been a wealth manager before, a fund manager. Okay, he asked a very, very pertinent questions in asset allocation, planning, and execution. Okay, what type or category or class of debt funds to choose from? He says that almost 16 kind of debt funds exist. Okay, so equity, we know there is growth, value, mid cap, large cap, flexi cap. Okay, so as a wealth manager, and you also stressed on risk and an asset allocation. So I think you will take that answer very, very judiciously and very, very interestingly. So over to you.
Yeah. So actually, the most difficult part today is debt. Okay, other than equity, because I think debt will give poor returns, and so that's a starting point. So that's a bad news for anybody who's looking at debt. There. So and what is the reason for it? Say debt returns on the lower end, safe returns are very low. Right, liquid returns are very low. So you may even have some funds on the liquid side which even have been giving below 4%. Okay, so that's the type of thing. But typically you may have 4.5%. If it's a liquid fund, and even for more aggressive risk type of avenues, you would find that the returns have come off significantly. And we all at the back of our mind have the Templeton fiasco, and so we should continue to be careful on quality of debt. Right. So I think, and as a fund house and as a wealth manager, we always have felt when you're looking at debt, we look at safety more than trying to get the returns there. So what are the categories? So keeping this in mind, liquid may not make sense. So if you are able to keep it for a slightly longer period of time, I think you can look at ultra short term. You can look at floating rate funds. I think floating rate funds may be a good option to look at, because the thought process is that interest rates may start slowly inching up, okay, over the period of time, and so having higher, let's say, tenure investments there may not be good. It may, in fact, you may get lesser returns than even some of the ultra short term, etc. So that is something, and definitely no to income. Okay, maybe if somebody is willing to take a slightly higher level of risk, then you can look at corporate bond funds. You can look at credit risk funds, but you have to be very, very careful about maybe which is the fund house. And I think the past period has actually shown which are the fund houses that have not got impacted by credit risk, and you should only look at some of those. But I would like avoid it at this point of time. But only if you are slightly aggressive investor, that's something that you can look at.
Thank you, and I think that answers a lot of questions of investors on debt allocation. Another very interesting question. Okay, I'll come to that. So before that, quickly, growth or value? What is which side do you or Right Horizon fundamentally aligns to? I know one of your fund is called Super Value Fund. Also concentrated or diversified? We'll take these quickly because we have other interesting questions as well.
Yeah. So super value, just to clarify, maybe the name may not be appropriate from a value side. Okay, so it's just that it's a mid cap fund, and it's not necessarily saying that we only invest in value stocks. Okay, so I think over a period of time, value will over the next few months, value will also get into prominence. But so what we like to do, can we get the mix? Okay, can we get a combination of both? Okay, and that something which is growing well and not very highly valued is the is the segment that we are trying to look at. It's getting more and more difficult as markets are moving up, right? So, but yeah, so that is something which because we've locked in some of them, I would look at doing a combination of both, not going excessive on the value side, but yes, I think value will do maybe even better than some of the growth companies which have been growing in the past.
Right. Okay. Concentrated or diversified? Or what is your right mix of stocks in a portfolio?
So I would still, for part of our portfolio, only look at concentrated, okay, because market valuations are high, and I would like to be conservative. Otherwise, if it was an early stage, I would have said concentration, okay. So possibly, what you can do is have a smaller part of your portfolio in strategies which are concentrated, but maybe have maybe 60% in on diversified side.
Okay, so thank you. Another interesting question from Nishida comes. Okay, it's a very interesting question actually. So we all know that as interest rates or policy rates across the world come lower, it obviously has an effect on equity returns as well. Okay, so she asks, do you prefer companies which have slight leverage now that we are in a low interest rate environment, given that now you could cover now with a lesser return on capital also, you could be above the cost of capital per se. So what's your view on that?
Yeah, so at a time like this, I think like earlier was leverage was no. Okay, today it's okay to also look at companies with a reasonable leverage. The environment is not, you're not in a phase which is completely great, and there are no risks around. So I would still be a little cautious, with COVID around the horizon. So I think I would think that leverage is what you can do, but be a little cautious on how you go about it, and maybe take a few calculated risks, I would say, okay, for part of your portfolio. But even though it may do better, so this is part of our philosophy, unfortunately. So you will still go back and say, okay, let's go for quality. But yeah, so if the leverage is fair, then leverage companies can go faster in this periods of time because they benefit most from the fall in interest rates. Okay, so there's no question about it. So they could do well, but I'm saying keep it to a smaller part of your portfolio from managing this standpoint.
Right. So that's again, I hope, Nishida, your question is answered there. Okay, quick one, view on e-commerce startups. Now that we have 21, I think we added 21 unicorns in, first half calendar year. So
Yeah.
quick view, and what happens when they hit the public markets.
Yeah, so I think like all booms and busts, right? I believe that somewhere we'll end in a bust. Okay, so on this side, but the thing is, there may be money to be made first.
Right.
Okay? And I think Zomato was maybe the first one. So I think we still have some margin left, and the issue that you have is, as an investor, you're investing in IPOs. You get, the better the stock, right, and the better the oversubscription, you get lesser. Okay, so that's the, that makes us uncomfortable. So in our portfolio, for example, we may be extremely selective, okay, in terms of how we do it, for no other reason that I may just not get sufficient allotment that I want, okay, and for the quality names that I want, I may not get sufficient allotment. So I think look to ride the wave. While a lot of people who say valuations are steep, etc., I also believe that. But in some of these cycles, right, the valuations can actually still go berserk, because the fact is, they are going to grow faster in this period of time, and there's a bit of a market share movement which has happened from other companies to them, right? So that is, and that will, I think, continue for a little bit of a period of time.
Right. So, Anil, with this question, we will end, our interesting session today. Sectors and views for the coming couple of years or the next 4 to 8 quarters. And with that question, we'll probably wrap up today's interesting discussion.
Yeah. So I think I did speak about manufacturing. I think manufacturing will continue to do well. Okay. We have looked at new age businesses, and we have chosen listed stocks which also are, let's say, on cloud communication and digital marketing, and some of them which I think will sort of continue to do well. Okay, part of it is, I think, about looking at bottoms up stock picking. So you have stuff like there are a few companies which have a significant market share, which are monopolies, and if I may name one, of course, again, I'm saying this for illustrative purposes, okay, is IRCTC. Of course, if there's any, it could see volatility if we see a third wave sort of coming in around COVID. So you have to be a little cautious about how you go about it. But names like that, I think, in the long run will sort of monopoly and do well. On the pharma side, also, we like specialized thing around the APIs, and we think that is something which one can sort of look at. Chemicals, I think we continue to be bullish, but we have to be we have to be picky and choosy about how it is. Okay, and in a little bit of we have also, in the recent past, when I looked at cycles, for example, we've looked at metals, and we entered into metals a little earlier, so it has given, in a very short term, good returns. But I also we use it very, very carefully, especially cyclical. So what we do in our overall investing process, we keep about 15% aside for cyclicals and other names. Okay, so that's all the margin that we can play within our portfolio, and there we have sort of looked at even the agrochem. I think sugar should also sort of do well. So those are various sectors. Apart from, I think what is core in all of this is also looking at bottoms up stock picking, because if you are able to find names which are, say, number 2, etc., which are very well positioned to either expand at the cost of the smaller ones, or even grow to a number 1 position, I think those are the companies which will sort of do very well.
Thank you, Anil.
Maybe what I could also do is, maybe you can reach out to me if you need. I see a lot of questions which are there.
Right.
So I'll just post in, my email ID and, yeah, and so that is maybe something that, you can reach out and feel free, and myself or my team will try to, support you in any sort of
Right.
queries that we have.
Right. Thank you. Thank you. That was very insightful. A lot of learnings, a lot of lessons, both in terms of money management and wealth management. So to the audience, Anil has dropped his email ID. So for any thing that remains unanswered on this call due to the lack of time and nothing else, please do reach out to him. Thank you, Anil, for being with us. Thank you to the audience for being so patient for for the last 1 hour, and we hope to have all of you again soon. Stay safe, stay home. Thank you.
Yeah. Thank you, Sankalp, and thank you all the people who attended and participated. Well, thank you.
Thank you.